and welcome everybody to our Start Smart on phase part one, doing your capital raise. So my name is Kit Needham. I'm Assistant Dean for Entrepreneurship Initiatives and Director of Project Olympus at Carnegie Mellon University. I help students, faculty, staff, alumni explore the commercial potential of their ideas and innovation. And I've been doing this, we've been running this program for a long time with my colleague over at the Pitt Law School. Stephanie, if you're off of mute, you can introduce yourself.
Yep, I'm Professor Stephanie Dangle over at Pitt Law School. I teach a lot of classes in the innovation space and the entertainment space, and with one of my colleagues on Zoom with us, Jackie Walker.
Jackie in there too. And also with my colleague over at the Pitt Big Idea Center, Rhonda.
Hi, thank you. Rhonda Schultz, Director of the Big Idea Center. We are Pitt's hub for student innovation and entrepreneurship. And I'm going to leave it at that because I'm losing my voice. And I have esteemed people that I work with, including my colleagues, Stephanie and Kit, and obviously David on the legal side, and also our entrepreneur in residence here, Don Morrison.
Who's also CEO of a new company now too. And also one of our colleagues in the ecosystem, Jesse Mazzoni, who is over at that Alpha Lab Gear. And I think also is helping out with their new robotics factory, which is another one of their accelerator programs they opened up.
Hi, thanks for the shout out, Kit.
Okay. And is your application period still open?
It is open through the end of this month.
Okay.
And for those on the call here, we will be hosting at the Big Idea Center next Tuesday at 2:30 an information session with Jesse and Deanna, right? We also have somebody here, I think, from Alpha Lab as well, or IW. And so, if you're interested in that, just drop a chat in the your email address in the chat, and we'll make sure you have the information on that.
Thank you so much, Rhonda, for the shout out as well.
Absolutely.
Okay, so just as a reminder, everybody, this is part one. This is where you learn the terminology and the different items that are involved in negotiating your raise or the term sheets. Part two will take place, and I've got to get my calendar up here, I think in 2 weeks or so. And what we wanted to do is have this be a prep for the session that comes up, and that where you actually will negotiate a term sheet. And what we do is we literally will take half of the room and we will put one half will be the startup, and the other half will be the investor, the venture capitalist. And then you will both go and talk about the term sheet and decide what terms you're okay with, which ones you're okay if you're the investor, that if the startup proposes an alternative, what you're likely to accept or what you would not accept. The startup, of course, will say there are certain things in here that's not acceptable because it's meant to be they're not supposed to be perfect term sheets. And then we'll come back together. We will ask for a couple volunteers, and then you'll negotiate that term sheet. So this session prepares you for that, so you understand what some of these things are, what the elements are. So before I get going again, and before David has to remind me, one of the things we always do in these sessions, we call them connects for a reason. It gives everybody an opportunity that if you're looking for a team member, if you're somebody looking to join a team, if you have any announcements about something happening or coming up, or if you need any help with anything, like an introduction to somebody, this is your chance to speak up. And if so, just take yourself off mute, give your name, what you're looking for, and take advantage of the fact that we have people here that can help. Okay. Well, if you think of something along the way, you can put it in chat and just make sure you put your contact information for people to follow up. So let's begin the show. In this case, I'm going to introduce David Lehman, who has been a partner in this from day one. He is with K&L Gates. And David, I'll let you take it over from here.
Great. Well, thank you, Kit, and thank you all, and thank you for joining. Let me share my screen if I can, if I know how to do that, but we'll try it. This never goes well. And I take it you can see the screen. Kit, you're muted.
Do you want to hit the presentation?
That never works, but I'll try it.
We'll try again, yeah. Maybe we'll be surprised.
Did it work?
No,
No. For me, it isn't. So let's not do that. All right. Can you see it? Still in
what I see
presentation?
it is the
Okay, let's-
presenter side of it with the slides on the side, but that's okay.
Yeah, let's do that. Okay, cool. So, so we're going to talk about capital raise, and you will see that we'll talk about some of the challenges and alternatives, some of the applicable laws. We're going to talk about the security that you would offer when you raise capital, debt, stock, convertible debt, this strange thing called a safe that seems to be quite common. And I want to spend more time than I usually do on convertible debt and safes, because when you raise capital, that's usually where in the first instance, that's usually where you raise capital. So let's spend some time on that. And so we'll pause there. We'll talk about, no matter how you raise capital, some of the commonly discussed terms and things that are negotiated, such as board representation and control, somebody vesting your stock, the principal stock, etc. We'll talk about some of the pitfalls and mistakes people make, and finally, this says, and I want to emphasize, question and answers, but don't wait. It will be extraordinarily boring if I talk for the next hour. So please, there aren't that many people on this call. So if there are things you want to pause at, talk about, clarify, talk about something different, please interrupt, and we'll talk about that. So feel free. And you can put up your hand, and you can just interrupt me, whatever you want to do. It's just fine. Again, there's not that many people on the call, so we can just be amazingly informal. With that, let me just launch into it a little bit. And one of the things that I just, when you raise capital and you issue equity, there's a natural balance that one has to think about. And you need to think about sort of, there's turns out there's only 100% to give away. If you give more than 100%, then you have to worry because you'll be in jail. And none of us look good in orange jumpsuits, so let's not do that. So I gotta balance 100% of the equity among people with competing interests. Obviously, we have the founders who make the original contributions and ongoing contributions, so they need to get equity and et cetera for that. You're going to have the management, the CEO, CFO, people that can actually drive the business going forward, and you want to properly incent them. You get people who can put ideas and innovations into the business, and obviously you got to have room for the capital. You got to know that when you bring in new capital, they're going to want a property return on their investment, so they're going to get equity as well. Somehow you got to balance all these, and you got to think about that. So, for example, when I give people, founders, equity, we need to know that we're going to get diluted for the capital, for example. And I will say that one of the mistakes that we see most often, is that a lot of the equity is given to people who perhaps are not driving the value going forward, and that's not favorably looked upon by investors. It's a bit of a problem. And so when you think about the capital structure, think about who's going to drive the value going forward and who really should benefit from it going forward. And so we do. There's lots of time spent, and we even have other presentations on the founder's pie and how you allocate among people. But think hard about making sure that people who aren't contributing going forward are not overrepresented on the cap chart. That's the basic point there. When we talk about raising capital, we immediately do not pass go to collect 200 without saying, all right, let's go get money from the outsiders. Let's talk about raising, angels, which we'll talk about, or venture capital or third parties. And I do want to pause and say, okay, but let's think hard about other ways to raise debt, I mean, to raise capital. The best is customers, right? Some of my happiest clients are those who never took a nickel from anybody, because then when they have issues down the road, they didn't have investors to answer to. They didn't have to worry about that. They simply, they made a little less money. And you can do that through bootstrapping with customers, have them pay for a pilot in exchange for lower values, prices going forward, exclusivity. There's lots of ways to do that, and that's sort of is similar to bootstrapping. You can license your technology out for fees, so do that. Obviously, you can go for public financing and SBIR and STTRs, and when you're forming your company, I just want to think hard about if you're going to go that direction, because as we all know, for SBIRs, there's some limitations on ownership. So when you're forming your company and you think you're going to do some public financing, just remember in the back of your head what I'm saying now, which is think about structure, because as we know, you can't be owned by more than, as a general matter, if you're doing an SBIR or an STTR, it has to be owned at least 50% by an individual who's a U.S. citizen. So you got to make sure that you take into account when you're taking outside equity later, and you're going to do that. That may dilute the individual owner to less than 50%, and you may find yourself ineligible for the STTR or SBIR. So just take that into account. But the bottom line is that and with crowdfunding and debt, all these are ways, and we'll talk a little more about that. But the point is that to the extent that you have available non-dilutive financing, and that's or customer financing, that's kind of a nice thing to think about. So when you think about raising capital, just pause and say, are these alternatives available to you, and make sure you think about it. That's all. Let me just make sure there's a phone call, and I want to make sure it's not making noise for you folks. The funding cycle, there's incubators and accelerators around town, and there's public financing that we talked about, Innovation Works and others. Then there's friends and family who you take money from, angels, who are sort of sophisticated friends and family, sophisticated folks, not quite venture capitalists, but people that have significant wealth who want to, as part of their investment strategy, invest in these types of startup companies. And some even specialize whether early stage or late stage. And then obviously from there you go to venture capitalists and strategic investors, and some of those specialize in early stage versus later stage. And obviously eventually you can go to the public markets. Those are different ways to raise capital. We're going to focus mostly here on sort of the ones that are highlighted there: friends and family, early stage angels, and venture capital, early stage. People often ask me, what's the difference between angels and venture capital? And it's not really that huge. It's really the nature of the investor. Again, angels are typically tend to be well-heeled individuals. Venture capital funds are funds that are put together for the purpose and pooled for the purpose toward investing in these kinds of investments. And they often have different kinds of constraints. I'm going to spend a few moments, not that long, but a few moments just sensitizing you to the securities implications of raising capital. And this is not a securities 101 class. I don't know that I'm equipped to teach a securities 101 class, but regardless, but we need to at least know that it's out there. And this all stems from the Securities Act of 1933. Which is intended to regulate the sale of securities. And securities is a very, very broad term. It's basically anything that's called an investment contract, and it's basically anything: stock, notes, bonds, etc. They are securities, short-term notes. And as a general matter, under the 1933 Act, if you're going to sell a security, you have to register with the SEC, file a registration statement. That is a long and expensive process, well north of $1 million, well north of $1 million to register. So the whole goal is to have an exemption from registration. That's it. That's all we want to do, is get an exemption from registration so you don't have to do it. It should be noted that the exemption from registration, that's all it does, exempts you from that. You don't have to file the registration. It does not exempt you from two other things. Notice filing, which we'll talk about, which is you have to file, I mean, if you use Regulation D that we're going to talk about, you have to do a notice filing within 15 days after you sell securities. And it doesn't exempt you from fraud. So you can't defraud people. You will still be liable under the 1933 Act as well as common law for fraud. We'll talk a little bit about that as well. Not how to defraud, how not to defraud. Okay. And Regulation D, the one that we're most used for a variety of reasons, is what's called Rule 506. And there's two flavors, 506B and 506C. And 506B allows you to sell up to an unlimited number of accredited investors and up to 35 unaccredited investors. And you have to have a reasonable belief that they are accredited investors. Now you may say to me, okay, so what's an accredited investor? Funny you should ask. An accredited investor has to meet these criteria. They're on the screen. The one most common is somebody who has an income for the last 2 years of at least $200,000. Or a spouse $300,000 with an expectation of the same this year, or a net worth of at least $1 million, excluding their residence. There's been lots of discussion about this has been the definition of accredited investor for quite some time. There's been some legislation or proposed regulation to change this and enhance it. So far, that hasn't happened. So this is still the rule. So if you have these, you can, under Regulation 506B, you can have as many accredited as you want, and I can say up to only 35 unaccredited investors. In order to get this,
hey David.
Yep.
I have a quick question. This is Troy. For accredited and non-accredited, is there a process a person goes through with the government to get accredited to say that they're an accredited investor? Because I hear the term a lot, but I haven't heard like, is there a process? So we're doing, some friends and family with high net wealth people. I'd prefer to have them maybe on the accredited side. And it sounds like that maybe is important, but what is the process for being accredited?
So Troy, that's a great question. For purposes of the 506B, the one on this, well, first of all, there's no government accreditation. It's not, nothing to do with them. They don't get into it at all. It's, you need to satisfy yourself that they're accredited. And so there's, with respect to the rule I'm discussing now, 506B, you can simply have them certify that they are. And sometimes we have people, we have to do some reasonable diligence to assure that they're accredited investors. So we typically give them accredited and a questionnaire, which asks them some questions. And that's all you have to do. There's you'll see in 506C, the other exemption, which that you have to go a little further. That you have to get them to either look at their tax returns or get a accountant or somebody to certify that they're accredited. So you got to go a little higher, and I'll explain why that's the case in a little bit.
So for accredited, I could simply have our lawyer give us an accredited questionnaire that we send to them. They fill out, send back, sign it, saying, yep, to the best of my knowledge, I'm telling you the truth, and that's what you take as face value.
Correct. Yes, sir.
Okay. Thank you.
For 506B.
Got it. Thanks.
And the reason an important part of 506B is that you cannot do a general solicitation, which means that you may not advertise for investors. No things on your website that say we are looking for investors. No mass emails to a lot of people saying I'm looking for investment. There may be no general solicitation at all, ever.
David, does that include, I would imagine, things like LinkedIn posting and sort of things like that out to your network by that means?
Yes. Yeah. A LinkedIn network, I would say yes. It includes that. Yes.
Great. Thank you.
You have to have a reasonable belief that the purchaser is purchasing for purpose of investment. That's easy to do. And have a file Form D with the SEC within 5 days after the first sale, as I mentioned earlier. That's very easy to do. But you got to do it within the 15 days. Okay, that's for the 506B. 506C But 506C actually eliminates the prohibition on general solicitation. You can actually do this. So you can send your email to your folks on the LinkedIn page, network. You can you can do anything you want other than fraud to solicit people. For that, there's no 35. You can't use it. It's only to accredited investors, and you have to go a little further to make sure that they're accredited investors. So just the little questionnaire that I talked about, you go a little further. There's a heightened verification. So you can, I'm not sure that I put it up here, but you got to, and it's not a big burden. It's just a slightly bigger burden. You got to either look at their bank statement, or you got to get their accountant to certify it. So it's not a huge thing, but it's a little higher than just the questionnaire I described. The issue though is you got to decide early which direction you're going to go. If you do the general solicitation, then there's no reversing. You can't go back and try to get back into 506B because you've already elected essentially 506C because you've already entered into the general solicitation. Okay. So we're either going to try to find it 506B or 506C. And I do want to make one comment about, don't forget about states. It turns out we also have, each state has its own securities law, aren't we lucky? But unlike when Stephanie was doing 50 state security, blue sky memos, we don't have to do that anymore. There's a national statute that allows us to basically preempt state laws. If you comply with Reg D, you will comply with the other states, but there is a notice requirement in each of the states that you sell in. So, and some people blink at that. That's a mistake. You should file the Form Ds in each state in which you sell as well. Okay, and again, it's relatively easy. There is a filing fee, but one should do it. So the bottom line is, pick 506B or C, and decide early, as I already said. So, some people say to me, okay, so why should I do this? And there's really a couple of reasons. One is if you fail to do it, a buyer basically has a rescission right. If you fail to do it, then they basically can come back up, say you didn't touch base. I can rescind my offer, and you can't afford to take it, so that's a problem, and that's something. Investors and purchasers, it's so easy to do this, and it's and you check the box, and when investors or purchasers come in, you just hand them the filing, and that's the end of it. If you don't do it, it raises lots of issues and can affect your ability to raise capital or like the VC round, if you don't do the right thing on the angel side. So it's worthwhile doing it there. And frankly, it's your insurance policy. If you do all this, then it's harder for people to come back at you. So it's the right thing to do, and I strongly encourage people to comply. The next issue is our securities whole regime is really, once you file in this, it's really about telling people what they're buying. And some people go through a whole private placement memorandum. If you're raising a few $100,000, you can't afford to do that. But I do like to give people, but sometimes if you're raising a few $1 million, we do a private placement memorandum, and do a whole description of what you're doing. At a minimum, and then this is the outline of what you would have in that private placement memorandum. But I do sometimes, even if you're not doing that, it's nice in the subscription agreement to have a exhibit that describes the risks that people are taking. We all know, we hope that we'll be hugely successful. It turns out not every startup is hugely successful. And so it's nice for the investors to look at the risk factors, et cetera, and see what can go wrong. And it's ironic that the more voluminous the list of things that can go wrong you describe, the less likely people are to read it, and the better it protects you, as strange as that is. So I encourage my clients to think about everything that can conceivably go wrong. We think about it for a while and list it, and that way nobody can ever say they don't know about it. And the other thing is I want to disclose conflicts of interest. To the extent that you as founders are taking money or have arrangements, let's make sure the investors know about it. So that's the disclosure piece of it. I don't want to spend a lot of time on crowdfunding because it's not really used much in our world. But I do just want to distinguish the sale of securities versus the other crowdfunding. And people do do things like raise capital through basically selling products and things, and I don't have any problem with that. These are just a couple of examples of shell games and that is used to raise money, and that's fine. And that's an alternative because it's non-dilutive capital. But the point is that shall not sell securities doing this. It's simply using it's basically a fancy way of selling, giving things away in exchange for the capital. I don't want to spend a lot of time on that because people don't typically do that here.
David, could you touch on, there are some crowdfunding equity sites out there, WeFunder and some others. Could you talk about the risks of doing raises through those?
Yeah, so what I have found with those generally is that two things. One is they are deceptively expensive and time consuming, because you end up doing the full disclosure as you would expect. The platforms aren't taking any risk associated with it. And so it ends up being expensive because of the disclosure and the lawyer fees associated with it. And so that's my principal gripe with it, actually, turns out. And so when you have to do the disclosure of the financial statements, and get the appropriate financial statements done, like audited in some cases, et cetera, it just becomes non-workable. So that's my basic gripe for it. You may, don't know what your experience with it, but that's my experience with it.
Well, it wasn't an option before because initially crowdfunding was, T-shirts and things like that,
right?
To raise money, but it seems to be there seems to be a little bit more momentum there. They've simplified it. They've figured out some of the issues. I mean, one of the issues that we would look at Blue Tree was, the cleanness of a cap table. If somebody had a really messy cap table, and crowdfunding, having too many people on your cap table is a real good way to get a messy cap table.
Yep.
But they've figured out how to do it in such a way where there's a representative from different groups, from a WeFunder or something.
Yep.
That keeps the cap table clean. So they've figured out ways around some of the problem, but I don't have a lot of direct experience with that, but I know it's getting better. So
yeah, but I've had clients look at it and I don't think I've had any yet that have ended up going that direction. They've always found it's too cumbersome, and expensive, but doesn't mean it can't be done.
Thanks.
Let me go to the type of security, unless somebody has any other questions before I get to that. Okay, so the type of security that one can offer, and this is just a list of the from the top of the, I'll call it the security chain. You can issue debt, basically, issue debt to investors. We'll talk about that, and that can be secured or unsecured debt, meaning there's security in it. At the bottom of the chart is common equity. And that's just a straight owner. The founders get common equity. Above the common equity is preferred equity, and we'll talk for a little bit about that, is what the difference between preferred equity and common equity is. And between the two is convertible debt and also safe notes that we'll talk about, which has the benefit of being debt, which then converts into equity, either common or preferred on certain events, and we'll talk about that. Let me start with debt for a moment. And we just did that. That's done. Debt. I mean, you could, your company could just simply go to third parties and your friends and family would say, okay, just give me money and I'll give you a note. I'll pay, X dollars back with an interest rate at a certain date certain, right? And that's pretty straightforward, right? That's kind of nice. And there's no upside. Just, I'll pay an interest rate and presumably it'll be a higher than market interest rate because there's a little more risk associated with it. It has the benefit of being amazingly simple. It's non-dilutive because you're not giving up more than just the principal plus interest. You're not valuing the company, so there's no question about what's the value of your company because you're just it's doing it. The downside is it must be paid. If you're there's a maturity date, so that's unlike equity, which if you don't make money, they don't get it back. With the debt, it's got to be paid. There's interest associated with it. It's got a balance sheet implication, which is that there's now a debt on your balance sheet of the amount that you borrowed. So that's a downside to it. From an investor perspective, the good news is that they're higher in the preference scale because it's high. It's potentially secured if you do that. There's a fixed return for investment because you know what it is. They say there's no upside. Interest tax come rather than capital gains, so it's not a perfect. It's not a perfect match there. The key, the issue, of course, for debt is that there's a lot of risk with no significant upside, and so in order to mitigate that risk, investors may say, okay, well, I'll do that, but I want some added security because I know I want the money back. So they may ask for a personal guarantee, which isn't, a principle. I mean, most founders don't want to give a personal guarantee because they don't want to have to, go into their pocket if the thing is not successful. So that's not perfect, but I've seen people ask for it, and I've seen people give it, and I'm not advising people to do it. I think it's a mistake. They may also say, okay, well, I'll do it, but I want a security interest in the assets. So if I'll take, if your basic asset is IP, then I'm going to take a security interest in your patent, for example. And as if you're not successful, I'm going to take your patent. And so maybe they're willing to do it if that's the case, and maybe that's okay if you want to do straight debt and not give people the upside. My experience is that this is fairly atypical, that most startups don't, unless there's a family relationship, don't get debt, sort of straight debt as security. One other caution that I've seen people do, so I'll just alert you to it. If you do debt and you are an LLC as opposed to a C corporation, one needs to be a little careful about the debt and what happens if it doesn't get paid or you go into trouble, because that forgiveness of the debt can be income to the principal. So you may create an inadvertent tax issue for yourself. So if you do straight debt as an LLC, just talk to your lawyer about the potential tax ramifications if that debt goes bad. That's just one caution there. So that's the highest level. The lowest level of equity is common equity, where you say, look, it's all for one and all for one. And so the founders have common shares. Our investors are going to get common shares. And so if you want, you'll give me $100,000, you're going to get 10% of the company, and all our interests are exactly aligned. It has the benefit of being amazingly clean. It's simple. It aligns our interests. When the founders make money, the investors make money. Because it's not preferred or a preferred stock, or it doesn't have the upside of a preferred stock, it sometimes will yield a lower valuation. Because there's not going to be a preference or accrued interest or those kind of things that we'll talk about on the preferred stock. So it's not getting those benefits, so it's a lower valuation, and it requires a valuation, importantly. So if my example just now, if you give $100,000 and you're getting just for fun, $1 million, 10% of the company, then it has basically a $900,000 pre-money valuation. That's not our $1 million post-money valuation. We've now decided what the valuation of the company is. And convertible debt and even the term note, we don't have to determine that valuation. So that's something that's one of the downsides to providing equity.
David, could I rewind for a minute and just editorialize a little bit on the debt? If you could go back to your debt slide.
Yeah.
So I've got some experience in scar tissue dealing with banks. My experience is banks are perfectly happy to lend you money if you can demonstrate you don't need it, meaning you have lots of cash,
Yep.
lots of assets. But if you're an early stage company and you need, if you need funding and you're looking for debt, they will ask for personal guarantees. It's usually advisable not to sign personal guarantees, but sometimes that's the only way you can get a loan completed. Personal guarantees and also collateral. They'll ask you for collateral. If you don't have collateral sufficient to satisfy the bank, they'll ask you to mortgage your grandmother's house or whatever else. So, my advice to everyone is if debt is an option, shop around because, some banks are more flexible than others. Most are not very, very, very flexible, and it's not usually the best way to raise capital. That's why not too many people do it. But, it's proceed with caution if you're doing debt. As David said, you do have to pay debt back. And a lot of companies run into trouble by, borrowing more than they can really afford to pay off.
So it's interesting, Don. I've seen there's two things. One is that there's I was thinking in terms of angels who or friends and family who may decide to do debt as opposed to equity rather than a bank, right? Because I think most startup companies, as you say, short of some kind of really amazing security, whether it be a heavy personal guarantee or collateral, they're not going to do debt. And so you can go to friends and family you may discuss doing debt from a family member as opposed to equity from a family member or friends and family or something like that, right? A debt round. And I've seen people think about doing that. The other piece is that the other place that it comes into play is when you have revenue, but you're still not profitable, but you have revenue. And the issue is that you don't have a track record sufficient to get, this is where the bank debt is interesting. And so you don't want to take equity because it's very expensive. You're not quite there for traditional bank debt. And so you end up with venture debt of some sort in that spot. And that's sort of interesting where people get into debt. But I take your point. Yeah. I can't emphasize enough the personal guarantee thing. One of the wonderful things about our system, and other people have heard me say this, is that it's great. You can, if you do it right, and you form a company, and you decide you're going to put X dollars in, and you put your blood, sweat in it, and it's successful or not successful. It is nice that you can walk away from it and not worry about what other personal assets you have, or walk away with that liability. When you sign the personal guarantee, it's everything's on the table. So there's a different match. Well, I won't go into that. Okay, got it. As I talk about equity, some people like to give just straight common equity, which is good. They don't get the typical price protections, and we'll talk about what those are. So I don't typically see angels taking common. It does happen. It's not with the same frequency. Let me talk about preferred stock. The other alternative is to give people preferred stock, and this is and VCs will almost always take preferred stock. Maybe I only almost always take preferred stock. Angels will sometimes take preferred stock, and it has the benefit of having a liquidation preference that we'll spend a moment on now. It accrues a dividend, and I said here it's not your Disney type dividend, it's not writing you a check every quarter. But what it is doing is accruing a return which will then be paid upon a liquidity on the sale of the company or upon the conversion of the preferred to common. And this, and the amount of that dividend is much negotiated, but it's really a assured increase in the investment that the investor has based upon time at an amount equal to whatever that return is, whether 8%, 6%, or whatever. So it keeps increasing their interest in your company over time, the longer they have it, is the way to think about that dividend. And it has some controls that we'll talk about later. So it has a benefit. Attracts investors. It gives them that preferred return. It's a little more complex. It requires evaluation because again, if I'm going to give somebody X dollars, if I'm going to take $2 million of venture capital, then how much the company am I going to give up? So it requires evaluation. And the interests may not be aligned because they're getting a preference or something. So the investors may want to sell at a time that common does not. Let me talk about the liquidating preference that will sort of maybe help describe this a little bit. And let me talk. I keep talking about liquidation preference, and liquidation of this that has a connotation that's not appropriate. It's like liquidation is a euphemism for a sale of the company, and that could be a sale of all or substantially all the assets. It can be a merger of the company to a third party. But it's basically liquidation for this purposes should be thought of as a sale of the company. And the preference that the investors get really come in two flavors: participating preferred and non-participating preferred. Participating preferred is when the investor gets their money back plus their dividend, and then participate on a pro rata basis. So if Don puts $2 million into my company, putting aside the dividend, when we sell it, he'll get his $2 million back plus the dividend. And then if he got 20% of the company, he would then get 20% of the proceeds, 2 million plus dividend plus 20%. That's participating preferred. Non-participating preferred is that he gets the greater of his investment plus his accrued dividend, or the proceeds his proceeds on a pro rata basis. So in my example, Don would get his $2 million plus the dividend, or 20% of the proceeds, whichever is greater. The difference is that the non-participating preferred is basically downside protection. Don knows that when I sell the company, he at least gets the first $2 million plus out of the company. So that's a downside protection. If we sell for $3 million, he knows he gets at least the 2. If we get 5, he gets at least 2. I mean, he knows there's downside protection. Participating preferred is an enhanced return. That both gives them the preference and enhanced return. Let me give you a couple examples. So if you take, let's assume a $2 million investment that I just referred to, Don's $2 million, and then there's a $3 million pre-money valuation. And let's suppose that would result in the founders having 60% and the venture capital having 40%, right? Because if they put in $2 million or $3 million pre-money valuation, that means that they now own, the venture capital gets 40% of the company. So let's use a couple examples here if we can. Let's assume the participating preferred, and again, participating preferred means the investor gets their money back plus their pro rata share. So if we sell for $2 million, the founders will get nothing, and the venture capital will get $2 million. If we sell for $5 million, the venture capital again gets their $2 million back, plus 40% of the difference of whatever's remaining. So they get $2 million plus 40% of $3 million, which is $3.2 million, with the founders getting $1.8 million. Similarly, $10 million sale, $2 million plus 40% of the remaining $8 million, yielding 5.2 versus with 4.8 points of the founders. Now let's compare that to the non-participating preferred. Again, non-participating preferred means that you get the greater of your investment plus dividends, but I'm not doing dividends because it's a simplified version. The greater of your investment or your pro rata share. So if we told the $2 million, again, they get the $2 million, 0 to the founders, same result. sell for $5 million, they would get the greater of the $2 million, or 40% of $5 million, turns out the same number is $2 million. And the founders would get $3 million. Note the difference. 3.2 in the participating preferred, $2 million on the non-participating preferred. That's a big difference. And this is similarly, $10 million sale, they would just get the 20%, which is $4 million, as opposed to the 5.2 in the participating preferred. It's a $1.2 million difference. So I'm not saying that one is better or worse, but sure as heck we should understand this when we negotiate the term sheet with the investor and when we're negotiating it, right? Because this is part of the economics of the term sheet, or the negotiation of the with the investor, participating versus non-participating preferred.
So I'm just going to make a plug on this. Actually, David, I'm going to quote you. This is for the law students in there that if you went into law because you're not very good at math, you're going to have to get over this. And for those who are starting companies, you need a lawyer who actually will do this math for you. So it's not just a concept. You actually understand what the bottom line implication is. You should expect this type of, tell me what this means in terms of how it will look at the end.
So, and Kit, you're right. And let me expand on this. We're going to talk about convertible debt in a moment. And I can't tell you how important it is to and we're going to talk about caps. And we're going to talk about the caps on the term sheet and what that means to you. And it's essential that you do pro forma cap charts to show how much equity you're going to get versus your investors get under various scenarios. And that goes to both preferred stock that we're talking about here, convertible debt, safes. And I'll give you some pretty strident examples with the safe that I'm not sure everybody understands when they do this, and we just got to make sure you do it. So to Kit's point, and I'll say it in my words, for the lawyers who went to law school, because you don't want to math, if you're going to do this kind of work, get over it. You got to do the math. You got to make sure your clients understand it. For the business people, this looks like lawyer mumbo jumbo. You got to understand these terms and make sure you got it. You know, it's funny because founders, and Don, you probably have seen this, founders love to talk about their business, and they should, and they're passionate about their business. It's huge, right? And they spend all their time on it. But you better understand this, because this could overshadow the wonderful things you're doing with your business by virtue of basically giving away huge portions of your business without realizing that you did it. And you end up working for somebody else without realizing it. I'm overstating it, but I can't, but we need to really make sure that people understand these concepts. And it's a hybrid of business and lawyering. So lecture over.
So David, I have just a quick question. Obviously, there's two different terms because they're both used. I've been digging in and reading and educating myself the last 2 months on this process. The participating, I've heard it stated as you get your cake and eat it too if you're an investor. My question is, and this is a broad question, I know why investors want participating.
Yeah.
But how is that beneficial to the founders and the startup companies? And in your experience, what percentage of, and I guess I'll say VCs, push for participating versus non-participating if it's just punitive to the founders?
So I'm going to, and I have to apologize because I have a company-oriented presentation. Orientation of my personality, right? Because I represent more of the companies I do. I represent some of the ventures, but so I tend to sort of lean things in the direction. So let me couch it the other way, which is to say, so I don't view it as negative as it's part of the economics, right? And so if you and so the answer to your question is people do it because they have to, because the market is what the market bears. And so if you're going to, sometimes you can't get a better deal. And the truth is, it's not the end of the world. If you're going to do really, really well, I mean, let me go to my example for a second. This is
if it goes to 100, if it goes to 100 million, it's not as big of a deal because the 2 million's immaterial. Yeah.
Right.
Okay.
What this participating is costing you is the your percentage of the company, of the investment of their investment. That's basically what it's costing.
Yeah,
It
yeah.
doesn't get worse over time. That's the amount. And so you take that into account, right? So that's
Yeah.
part of the negotiation process. So that's part one. Part two is there are hybrid. There are ways to negotiate it. As an example, you can negotiate that once they get, figure number 3 times their money, the participating preferred disappears. Which
Got
is
it.
that if they get 3 times their money, then participate. Then they'll get they just get their non-participating preferred. So you can
Perfect. Thank you.
negotiate it that way.
Yeah.
Yeah. The best strength you have in negotiating with potential investors is to have multiple term sheets, and to be negotiating and make sure they all know that there's negotiating with other venture capitalists. Then you'll get the best deal you can. You'll figure out where it is. I'd also suggest that you try to get different geographic locations. So West Coast versus East Coast, because there are different terms, the different locations that you can get.
Yeah, I've heard that and I love that advice, but then I also hear for every 100 no's, you'll only get 1 yes. So like, okay, so getting multiple seems like it's going to be really hard. So, but I
Yeah.
appreciate that.
Yeah, it's fair. It's fair. Yep.
Yep.
And of course not all investors are the same, right? I mean, one of the things in choosing an investor is you want to spend time. And I have real trouble ever telling somebody to turn down money, right?
Right.
And I have huge respect for money and people investing. So I put that. But you do want to make sure that it's not just about all the money, and you want to make sure that your investors are goals and et cetera are consistent with yours. And so you want to make sure they're good investors. I mean, you want to talk to other companies they've invested in, make sure that their timelines are the same as yours. Maybe they can bring other strategic opportunities to you that some other investors can't. So not all investors are alike. And I've seen some that are, frankly, basically are sharks, or for lack of other terms, and some that are sort of more work with the company. So just be careful.
Okay, thank you.
One of the things I'd suggest, Troy, is to save time and agony talking to a lot of investors and getting a lot of no's, do a lot of research up front. What David said is absolutely right. You want to make sure you're not just getting money, you're getting the right money in terms of values and objectives and things like that. But some companies, some investors have a niche and criteria of what they're looking for. So you can save a lot of heartache by knowing what are the right doors to be knocking on and which ones to avoid.
Yeah, for sure.
A lot of wasted time is spent entrepreneurs knocking on the wrong doors. So in terms of, it's not our space.
Yep.
Let me go to convertible debt, which is, it turns out that most of the time you start a company, the first money they take in will be convertible debt. And this is the so call it the best or worst of all worlds, depending on your perspective. And this starts as debt, and then it converts to equity. And the most classic round is it will convert to equity with interest earned thereon at a discount to the next round. So if you're going to raise money, so if you raise this convertible debt called $1 million, and then you raise $10 million later from a VC, they'll convert into the same security as the VC, typically at a discount. And you'll do it as a discount to that valuation because they got in early, they took more risk, usually at call it 10, 20, 30% discount to the next round. And that's the most typical scenario. And so today you have a debt, it accrues interest. And so that interest, principal plus interest, will convert at a discount to the next round. Usually preferred stock, but it could be common stock, whatever it is. It will also convert at a discount to if you sell the company. So typically it will say that if you sell the company, it will, and that discount rate will be different than the discount rate with respect to the raising capital. But the point is, converts. So if it doesn't get, by the way, if you don't, under convertible debt, if you don't raise the capital, then it will either, at the option of the holder of the debt, either convert or needs to maturity has got to be paid. And so that has a maturity date that has to be paid, which is one of the downsides of convertible debt. But that's generally what it is. I'm going to come back to the cap in a moment. I always say that there's no valuation, but there's sort of a valuation, because, as I said, if you get the maturity date and you don't have a and they want to convert, what's that going to be? What valuation is going to be? So you got to figure out the methodology to figure out what the valuation is at that point. So there's a bit of a valuation issue there. There's also what's called a SAFE, which is a simple agreement for future equity. It's there only, remind me what that stands for. And it also converts into, much like a convertible debt. Somebody gives you the money, they sign a SAFE, and it accrues interest typically, doesn't always, but usually accrues interest or an amount, and it will convert at the next round to equity, the same security, at a discount, much like convertible debt. It needs to be, if they sell the company, it needs to be paid or converted, much like convertible debt. If the company's dissolved or something, it's got to be paid before the equity. What distinguishes it from convertible debt is that there's no maturity date. It doesn't mature. It's an agreement to provide equity in this amount at a future date. It's not mature, so it's not really a debt. It's a contractual obligation to make the payment. And so, for example, under GAAP, I don't know that people treat this as a debt on their balance sheet, but it's typically very simple. People like safes because they're very simple, and it's become actually quite common. And it's very analogous to convertible debt. You can think about it; it has a lot of the same features and concerns.
But again, you need to do your research, because some angel groups don't invest in safes. Others do, but not all.
Both, I agree. Both safes and convertible debt have two features that I want to spend a moment on. One is a cap. So, and usually both of them, and this wasn't always the case, but I see it much more now. And I see almost all of the safes, not all, but I see many safes and convertible debt. Investors want a cap, which is to say that when it converts at the next round of financing or sale, that there'll be a cap, a maximum amount that the company can be valued for on that conversion. So for you figure your favorite number: $5 million valuation, $7 million, $3 million valuation. And this is to protect them against somebody coming in and investing at a very high valuation, and so they didn't get as much of the company as they had anticipated. And so they negotiate for a cap on that valuation on the conversion. And so let me just give you an example here of a $2 million VC investment that comes in on a $5 million pre-money valuation. And I suppose that there was a friends and family convertible debt or safe, doesn't matter, $500,000. And we'll do the 20% discount versus a $2 million cap, right? So the $2 million comes on the $5 million pre-money valuation. That means that the VC gets 29%, right? $2 million over $7 million is 29%. At a 20% discount, $500,000 at a 20% discount, take my word for it, is about 11%. And that leaves the founders with 60%. If there's a $2 million cap on the $500,000 valuation on the conversion, the VC will still get 29%. That hasn't changed. They're still doing $2 million on a $5 million pre-money valuation. They get 29%. The friends and family, they'll get 20%, not 29%, because they're investing $500,000 on a $2 million pre-money valuation. They're going to get $5 million. It's 20% of the company. And that took our founders from 60% to 51%. That's just one example of the effect of a $2 million cap on $500,000.
Okay, so
This is-
now I'm confused. I always
ahead.
thought the cap was, would it just say, you just said it was the value of the company.
Mhm.
But I see up there it's a 5 million pre-money valuation. So how can you have a 5 million pre-money valuation with the $2 million cap?
That's the point, which is to say that the new money is coming in at a $5 million pre-money valuation. The VC is investing on a $5 million pre-money valuation, but for purposes of the safe note or the convertible debt, it is saying, I don't care what the new money valuation, the valuation for purposes of the VC is. My valuation will be no more than $2 million. So for when you convert me, I'm at the cap. So that's $2 million. So I don't care what the VC's valuation is. That's immaterial to my deal. And so, unless it's lower than the cap, but assuming it's above the cap, it's notwithstanding the $5 million, we're converting me at $2 million. And that's why that number is so important. And so if you were to play with these numbers at all and say, okay, I'm going to take the $500,000 and I'm going to make it $1 million or $2 million, and you start playing with that number, and so that number gets, if you raise more money and that cap isn't very high, that can be extraordinarily dilutive to the founder. And I'm not, this is not a lecture that thou shalt not have caps. I think it's a way of the world. But it goes back to our original point that you really have to do pro formas and do cap tables to understand the implication of the caps on your cap chart when you convert. That's my sole point. It's really important. I have too many clients who or people that could be surprised if they didn't realize that's the case. That's my point. And we're going to get to pre and post money valuation in a moment, which is also something that you should fully understand. So when you're doing this, it's essential that you do pro formas to understand the implications of this convertible debt and safes and the implications of these caps, which have become so much more common than they used to be.
So the cap protects the early investors on the upside in case there's a higher valuation later on. Is there a point, David, where the cap becomes counterproductive to the early investors?
Only to the extent that they're only the extent that they're basically they become so, if you let me do it this way, if you raise too much capital in a safe or convertible debt, and with too low a cap, you basically will have diluted the founders to the point to oblivion, where basically you haven't incented the founders to really move the company forward.
What if the cap is too high or
well,
higher?
If the cap's higher, then it won't become. If it can't be too high, because when you'll convert at a discount to the venture capital. Then you use that valuation. So it basically becomes irrelevant because you're going to use the discount to the new valuation. So it would be as if there was no cap. So that's probably too high a cap is rarely an issue. I haven't seen that. The issue that I've had is that people with too low a cap and too much convertible debt squeeze out the founders, not giving them sufficient equity to drive forward, and nobody's happy with it. What you end up doing is renegotiating with the founders, with the debt holders, because they've squeezed the founders too hard. Because of the unintended consequence of raising too much convertible debt at too low a cap.
Yeah.
Is this sort of thinking about this in the way that you have this example structure makes me think that it's really navigating that sort of difference between perhaps a seed round and say a Series A, and the way I think about that is sort of these punctuated time periods. Or is it also in the case where you might be raising seed capital over a longer period of time with a greater difference of opinion, say if you're raising through multiple seed investors, but doing it over the course of, call it 9 to 12 months, with sort of how, I guess, what scenarios does this really come into play?
That's a good question. And so you might, to your point, which is if it's going to be over a long period of time and your valuation is basically increasing without adjusting this, you can do tranches with different value caps of valuations, right? And I've seen people do that. So which is to say, okay, the first seed round has a cap of $4 million. Now we've achieved something else. We don't actually want to go to a priced round. So now I'm going to increase the cap to $10 million, right? So I want to stay with the convertible debt or a safe route, the safe vehicle, but I want to adjust the cap to reflect the enhanced position of the company. And that's absolutely an okay strategy. And that does help address this concern. Yes. Yep.
Interesting. Thanks.
Yep. One nuance on the bottom there, but I'll say it and then you'll ignore it and just know it. With the advent of what's interesting and the reason this become into, because over the last few years we've seen more caps and more I think aggressiveness, which is just fine on the cap, which creates a bigger delta between the cap and the price being paid by the angels or the people who are holding this debt and the VCs. And so if it converts to the same security, the price paid by the note holder will be significantly lower than the VC, even though it's supposed to convert into the same security. That ends up with being some strange, as a technical matter, preference issues. The only reason I say this is you need to make sure that they're not getting exactly the same security. They're getting what's called shadow securities, which is the same rights, but a different preference based upon the price they're paying rather than the price the preferred's paying. A technical point, sorry for going in there. The other one I want to make sure we spend one moment on is, and I'll run out of time, but I want to make sure I have it, is pre-money, post-money for safes and convertible debt. If we do nothing else, I want you at least to be asking this question when you're doing the safes. And when we talk about pre-money versus post-money, I'm not talking about the VC money. I'm talking about the convertible debt money or the safe money. Is it included in the cap or is it excluded in the cap? Is the basic. Is it post-money or pre-money is the question. All right. If it's post-money, that fixes the percentage for the safe convertible note holders. They know exactly what percentage they're going to get in the company, and they're not diluted for future financings. Pre-money is better for the company. I think I did an example for this. So let me give you an example for the words I just said, which are almost indecipherable. Let's assume for the moment that we do $1 million in safes, convertible debt doesn't matter, with a $5 million cap. Okay. And let's suppose it's called pre-money valuation, which means that we're going to figure out how much I'm going to use safe just for ease, the convertible debt, the safe holders are getting based upon before the safes or notes are involved. So there's a $5 million valuation. That's the cap. Let's suppose there are 1 million shares issued and outstanding. The founders have 1 million shares. So it's $5 million because it's pre-money. It's before the safe holders of convertible debt. $5 million divided by 1 million shares is $5 a share, right? So my common have 1 million shares. My safe holders get 200,000 shares because it was a $1 million investment divided by 5. Even I could do that math as 200,000. That's 1 million to total. And our safe holders ended up with 16.67% of the company because it was done pre-money, based upon pre-money being only the issued and outstanding shares held by the common, not the note holders. Let me compare that to a post-money. Post-money means that the investors are going to get $1 million, that's their investment, over a $5 million valuation, because that's the cap. 1 divided by 5 is 20%, so they're going to get 20% of the company. Doesn't matter how many the price per share isn't relevant for this. They're getting 20% of the company. That in order to, there were 1 million shares outstanding. To get them 20% of the company, I got to give them 250,000 shares. So they end up with 2,250,000. Forget the math of how you number shares. The point is they end up with 20% of the company rather than 16.67% of the company. Okay, because the deal with that is they get on a post-money valuation, they're getting the amount of stock that they would get. I'm sorry, I would do it this way. Their investment over the cap of $5 million, 20%. The formula you will see is the more debt that you incur, if it's post money, the higher this percentage goes. So again, pre-money, post-money, really important when you're thinking about this cap. Is the convertible debt safe in or out of the cap? So when negotiating these things, and the advent of caps, the amount of the cap and whether it's pre or post money, really important to understand and do pro formas. Let me pause there. That was a lot of math, for which I apologize. So convertible debt safe. The good news is it sort of avoids the valuation, although with the cap sort of does. It's simpler, right? I mean, you don't have to do the preferred stock, amended restated certificate of incorporation, all that stuff. You're simply doing a note in the purchase agreement, so it's a simpler process. It does avoid the valuation at the moment. It does. Basically, what it's supposed to do is avoid the valuation, give people, the investors, the benefit of taking the risk with the interest and the discount, and allow them to take a discount to the future. And so you've got to be a little careful because sometimes the interests aren't aligned, but that's for another day. I'll skip that. I'll skip this. Let me do an example, a couple examples of priced round.
I have a quick question before you move on there.
Please.
As it relates to valuations and the avoidance of it, can you issue safes post a priced round, or can you do something to maybe for folks that do want to come into a round and maybe a more sophisticated investor wants to price it right where you've already kind of captured some some safes from others.
So you went a different direction on me. So the first question was, can you do a safe after you do a price round? And the answer is yes. You can certainly do a priced round, whether it be common or preferred, and then as almost a bridge, you do a convertible debt or it would be to the next round, right? So you do a series seed, and then you do a convertible debt or a safe to the series A, right? So series seed, convertible debt, series A. It's been done, and that's not all that uncommon. So that can show me, and the way to think about that is almost a bridge to the next round. And so you're not ready, you haven't got right to the point where I want to do another round, because it could either be a flat round or it could be a down round or whatever. It's not enough of a difference to merit doing another priced round. So that'll be a bridge to the next round. So that can be done. I think you had a question beyond the first one, so let me make sure I covered your questions.
No, okay, so that helps me answer the first part of the question. The second part was, if you have, if you're issuing safes and then you have a more sophisticated investor that comes in and wants to price the round, what do you do in that scenario? Because that obviously will impact, some of the caps that you may have established, and then someone else implies or imputes some other valuation based on their interests.
Yeah, well, so I mean, what it's going to do, if you've already done the safes, then that's going to, you're going to have to address them. They're either going to get converted, or they're going to, or something's going to happen with them. So presumably that's going to set the price for the round, because what they say is what most safes are convertible debts, that when you issue at a priced round, it's going to automatically convert. So if you're going to hit that threshold, it's going to automatically convert. If, on the other hand, it's an amount that's not going to trigger that conversion, So let's suppose you're going to try to leave the safes and convertible debt out, but also issue a preferred, let's call it a priced round. That is the definition of confusing. But it will, that's not typical. Because most of the time your safes well, two things will happen. One is your price round will insist that the safes be taken care of. They're not going to let them sit out there because they will have an uncertain percentage of the company. So that's not perfect. So they won't love that. So most of the time they'll insist that the safes be converted or dealt with before they put the money in. That's sort of the first one. Even if they did that, you're going to have to address it somehow because these people are going to want the same benefits as the others got as a general matter. So it's unusual to close a priced round over with the safes and convertible debt still outstanding. But not unheard of, but it's kind of unusual.
Understood. Thank you.
Other questions before I keep pontificating? All right, putting aside caps, which this one doesn't have, but just a couple examples. If you had a priced round and you raise, the founder has 1 million shares and the employees, you have created an option pool of 15%. So, they have 100% big deal. And let's suppose we do a priced round, $250,000 for the friends and family, $1 million pre-money valuation. That means that the shareholders will get, the investors will get 20% because at a pre-money valuation, 250 yields 20% of the company because that's 250 over 1,250,000 yields 20%, dilutes as shown. Then you do the Series A, and at what's called a $2 million investment, a pre-money valuation. That'll give the investors 40% and dilute people accordingly. Okay. You don't have to remember these numbers. You're going to see it again. Example 2 is let's say same start. We do convertible debt. So we issue $250,000 of convertible debt, 20% discount to the next round. We do a $2 million valuation investment at a $3 million pre-money valuation. Series A still gets their 40%. The friends and family convert at a 20% discount to the new price, the Series A price. The employee and everybody gets diluted accordingly. And also have the chart comparing the two. You'll see that the price, this is the price round we just went through. This is the convertible debt round we just did. You'll see that the founder went from 41% in this case to 46% in this case because the price that was in the priced round was less than the 20% discount to the preferred round. So they won the bet. So as a general matter, convertible debt will in the early round, because it's usually a low valuation for the early money, convertible debt will often yield a higher percentage of the company for the founders. It's a generalization, putting aside the caps. But generally, that's a pretty good bet. I do worry, I want to have one example of what I call too much convertible debt. The good news is that sometimes convertible debt can be addictive because you're not actually seeing it on the cap chart, and so people don't have a percentage, but it can be too much. Here's an example of $1 million of a convertible debt round, 20% discount. The Series A puts in $2 million of the pre-money valuations. They put 40%. Friends and family end up with 20%, 25%, and so you end up with this. So using our comparing it again, now we're down to 30% for our founders with 25% up to the friends and family. That's called too much debt. And to our discussion earlier, Dawn, I've had examples where people have just gotten too much debt. In one case, $9 million. And they, what you end up doing is going back and renegotiating with the founders, with the note holders, because they're just getting up with too much of the company. If you take the VC plus the friends and family, you put them together, there's nowhere for the founders. Going back to the very chart that I did originally, where you got to have money for everybody, you got to have equity for everybody. The founders got squeezed out, and so you got to go back and renegotiate. And that's what you're trying to avoid. So if you're smart up front in structuring these, then you don't have to go back and renegotiate with people. couple other high points before I shut up. I mean, obviously you'll have to negotiate approval rights and board representation. Reverse vesting, I do want to spend one moment. Often people ask you, and I find it in the first instance it sounds reprehensible. They want you as the founder to vest your stock. They say, well, I already own my stock. What's this about? But the answer is that if you were to leave and go somewhere else, the investors want to know that you're not going to walk away with all your stock with you. And so, because there's nothing worse than having a former CEO with 50% of the company. So they, or former founder. So they want you to vest your stock. And if you leave, then a good portion of your stock will remain with the company. That's called reverse vesting. And that's much negotiated, but something you ought to be prepared when you go into these negotiations of what you're going to be thinking about on that. I actually find it to be a reasonable thing to do, but it's something that you got to negotiate.
David, I've actually heard just in founder agreements that it's not a terrible idea to have that reverse vesting schedule in case one founder just decides they're going to pick up and leave between the operational agreements, just, so I found it to be a good idea, and it seems to make a lot of sense as well.
Well, I couldn't agree more. And so, I mean, and I'm a firm believer. And let me actually I'll take you one step further. There's vesting. And so the unvested stock, obviously they would lose, right? So if it vests over 4 years, the unvested stock disappears. That's easy. I actually will go one step further and say some portion of using the vested stock should be repurchased, or give the company the right to repurchase at the then fair market value. Unvested stock, you lose entirely. Vested stock, a right to buy from the founder or especially employees, a piece of the vested stock at the then fair market value. So they enjoy the benefit of the company from the time they came in to the time they left, but then we'll keep that stock forever. And so I can take back some of that stock, going back to my very first thing about balancing. And so I can reissue that stock to somebody else, right? So I actually suggest that you have founders perhaps should have some of the upside, but you can talk about buying back 50%, 75%, some large portion of their vested stock, as opposed to letting them walk out with all the rest of the even vested stock. So I'll see that and up you by one more. All right, I've used up all my time. Let me stop sharing. Any other questions before in the last 30 seconds?
Okay, one question I have is on the control piece, sort of thinking about what the cap table looks like, and is that, I assume that's the primary guide as to who has board seats and sort of the control that is either with or without the founders at that point. Is that a fair assumption?
Yeah, I mean, a rough justice is to look at the percentage of the company and say, okay, if the board if the founders have 40% or 60% and the investors have 40%, then 3 board seats and 2 board seats, right? I mean, that's sort of a rough justice, and that's actually not a bad rule of thumb. Then you're going to, but sometimes VCs don't want that, right? And I'll say, okay, well, that's good, but that's not what I want. And so we're going to argue about that 5th board seat, and should it be by a independent board member? And then the question is, okay, who appoints that independent board member? And who gets to pull off that independent board member if you don't like the direction they're going? But your basic question is a fair way to at least start to think about it.
Yeah. And will that, I guess, change depending on, sort of the investor, where they might say if they're an early investor, even if, sort of through the conversion process, they end up with a large equity stake, at that point, they may not have had an interest in being on the board, or at least having representation to the degree that their, sort of new, capped conversion is created for them.
Well, it's interesting. So, I mean, I actually have the opposite issue, which is that early investors who want a board seat and have board seats and then get diluted by virtue of the new money And so what's important is to make sure that right to a board seat disappears. So I don't have to go back and renegotiate that right away from them. I would say if you have to ask for something, approve or whatever, that's the euphemism for how much. And so I'm less concerned about them getting board seats later when the things when they put new money in or whatever than I am their rights to survive or interfere with the next round.
Gotcha. Thank you.
So David, if you have time, I do have a question. So we talk about the convertible notes and it avoids valuation kind of, and this is the area I continue to get stuck on. So we're early friends and family, we're early VC, we're pre-revenue, I got a 5-year pro forma. It's as good as the napkin it's written on, right? So I can do my EBITDA, I can do my 10 times multiple, I can discount cash flow it back to what I think the company's worth. How do you, and I know there's no magic answer to this, but like, how do you set a cap that's not going to get you in trouble when you're pre-revenue?
Yeah.
And nobody seems to address this. You can watch a million videos and read venture deals and watch 5 podcasts, but nobody addresses the proper way to set a cap that's going to end up being fair pre-revenue.
Yeah. So, and I take the point. I certainly, if you watch all that stuff, it ain't no fountain of brilliance here. But let me give you one perspective. One perspective would be throw out the word valuation and forget the concept of what something's worth. Forget that.
Yep.
The question is, what's a reasonable cap chart going to look like as you go forward and they convert? That's going to put people take into account the balances that I talked about. So, for example, if you go forward and you say, okay, I do a Series A, and your expectation on your pro forma is I'm going to do a Series A of X amount. What percentage of the company are you comfortable with them having at that point, right? So work backward. And so if you did that and you say, okay, you know what, if I do all that and it works right, if I raised $1 million for the angels, and they're going to end up with 10% of the company after that Series A, then you can work back on what that cap should be, and you're comfortable with.
But that's only if you know the valuation at the Series A.
Correct. So you got to do some what if assumptions on that. That's correct. So you got to do some assumptions on that. Yes. Yeah.
So I guess I'm confused why a 20% discount at these really early stages of investment isn't enough for most investors to say, hey, whatever we convert at, whenever we price around, you're going to get it at a 20% discount. And that's the negotiating point versus putting a cap on it that could take it to a 30 or 40% discount.
Correct. Well, first of all, I mean, you could as negotiating, you can, there's no magic to the 20%. So if you're, one way to negotiate away a cap is to say, I'll tell you what, I'll give you, based upon time, a 10,
Right.
20, or even 30% discount based upon what the length of time. So that's one way to negotiate a bad cap. Yeah, but I take your point. Another way to negotiate is, okay, what from their side, which is what's their risk? Their risk is this huge number valuation. So maybe the cap is not get away from value. The other point is get away from valuation. It's a protection. So what do they really need to protect it at, right? And so
but if it's a huge valuation, they're still buying those shares at a 20%. They just own less, but their ability to make X% return on their investment remains the same, right? They just have less percent of the company.
Well, not quite. Which is if they have just a teeny piece of the company, then at that valuation, then you got to sell it at a multiple of that to get that return, because they only got that little slice. So it works. I think that maybe it doesn't work quite that way.
Well,
right?
yeah, I suppose if you got valued high, though, the assumption is you're going to later sell at 10 times that high number as well.
Well, maybe, but that's the bet, right?
Right.
You're assuming because it was valued then, there's going to be this huge jump from there. And that, I don't know, that's
Sure,
an
sure.
assumption.
That's an assumption of a linear 10x regardless of initial valuation. Yes.
And that's an assumption that's been tested many times, not always to be the case.
Got it. Yeah, it's just a quandary that's really not addressed much as far as
Yep.
of setting that cap and how not to get yourself in trouble when, everybody says don't talk. They kind of say what you do, don't talk valuation. The market will dictate the valuation. Well, then how does the market determine my cap?
Yep.
It's a catch-22 I'm finding myself running in circles with.
It is. And there's no magic to this. As I say, I think you'd need to get comfortable with the dilution.
Yeah, which
associated
that I'm
with it.
comfortable with. So I know how much capital I need to raise. I know how much of the company I want to give away. I can do the Shark Tank methodology and say divide the two, and you get an approximate valuation of my company. And
Yep.
I hope that's good. But so I appreciate it.
Yeah. All right, team. Don's waving goodbye, so I think I need to wrap up.
Well,
All right,
thank you.
thank you.
Great.
Thank you.
Yeah.
Thanks, David.